Hello and welcome to the Business Standard Morning Show. I am Ruchika Chitravanshi. It is 26th of October 2023 and here are the questions we'll be answering today. Is there light at the end of the tunnel for tech sector workers? What will India becoming third largest economy mean for you? Should you buy stocks of oil explorers as crude prices rise? And who are the OBCs? Tech giants like Infosys and Wipro have given campus hiring a miss. Reports citing college placement officers and experts claim that there may be a 65% drop in recruitment of freshers this fiscal. Those on the rolls are not breathing easy either, as the season of layoffs is far from over and global headwinds too are refusing to budge. So in today's first segment, Kasturi Akhil tries to find out when will the tech workers breathe easy. Let us listen in.
IT service companies that have long served as the safe haven for engineering graduates in the country haven't quite lived up to their expectations this year. India's IT majors Tata Consultancy Services, Infosys and Wipro are set to witness a significant drop in headcount by nearly 50,000 in the current financial year, according to reports. In the opening week of Q2 earnings season, TCS and Infosys reported a sequential drop in employee tally. While Wipro and Infosys have explicitly said that they will forego hiring freshers from colleges this year, TCS has opted to adopt a more cautious approach. It has scaled down its hiring target to 40,000 in FY24 as opposed to hiring approximately 1 lakh freshers in FY22. Industry experts have flagged concerns on the global front, including recessionary fears in the US and geopolitical tensions in Europe and West Asia. These have rendered clients redirect their focus from newer and non-critical initiatives to optimization efforts. According to a Business Standard report, while campus hiring has hit an all-time low in the current financial year, tech majors may not hit college campuses in the next fiscal year either. Human resource managers told Business Standard that the batch hired in 2023 is still available for placements and those who already have job offers will be onboarded nonetheless. IT companies are now emphasizing on upskilling the existing talent pool in emerging technologies like generative AI instead of undertaking new campus recruitment.
There are certain skills which are becoming very relevant and they are very niche also and will definitely be in demand for the next at least foreseeable futures like blockchain, cybersecurity, artificial intelligence, machine learning, DevOps, and high-tech emerging skills like full stack. So there will be opportunities in these domains, and that's why the organizations are focusing on upskilling and reskilling of their employees.
Sachin Alag, CEO of workforce solutions provider NLB Services, told Business Standard he expects a further decline of at least 10 to 15% in campus hiring this year. Tech workers are facing challenges not only in securing jobs within tech major, but also in startups, where employee numbers have declined. According to data from layoffs.fyi, a website tracking job cuts in the tech sector, nearly 14,400 employees have lost their jobs in 2023, higher than the number recorded in the previous 3 years. On an average, around 49 employees working in tech-based startups lost jobs daily this year. It was fewer than 40 in the previous year. Despite the absence of major tech firms, campus placements are expected to remain stable. Recently, mid-cap IT companies and tech subsidiaries of large corporations have ramped up their hiring.
When the IT talent is not being consumed by the technology organizations, the non-tech sector is actually consuming that talent because of the adoption of digitization in the sector. Again, if we talk about BFSI, e-commerce, telecommunication, infrastructure, BFSI, pharmaceuticals, all these sectors are definitely hiring the resources, the top talent, and also the GCCs, global capability centers, which are setting up in India. They are becoming the consumer of the top IT talent in India.
So, when do industry experts expect major tech companies to start hiring again?
Most of these IT companies may not do in-campus hiring right now, but they may end up doing off-campus hiring in 24 June, July, once there is a little bit more stability around the market. So for short run, I would say this will definitely persist for some time. And then in 24, I think in the second half, you may see some turnaround happening also. And by that time also, India elections will also be over, new government will be in place. So hopefully with that, I think the domestic consumption and the domestic hiring should also pick up more.
It would be safe to say that as global conditions improve and discretionary spends by clients pick up, a potential turnaround is anticipated in the second quarter of FY25 for India's leading tech companies to hit campuses again.
But this tech sector has made India the world's favorite back office. It is fueling its growth as India is set to become the world's third largest economy. A recent projection by S&P Global Market Intelligence has predicted that India will overtake Germany and Japan by 2030. But how much will the common man benefit from it? Will it translate into improved formal employment opportunities, better healthcare, and an enhanced standard of living? Abhijit Kumar finds out.
Just weeks after the International Monetary Fund raised its forecast for India's economic growth for the current fiscal year to 6.3% from 6.1%, S&P Global Market Intelligence has come out with a report saying the country will become the third largest economy in the world by 2030. Riding on the sustained growth trajectory since 2021 and the strength of a large youth population as well as rapidly rising urban household income, the global agency has predicted that India will overtake Japan and Germany to achieve the feat. If true, this will make India the largest economy, only behind the USA and China. S&P Global has said that the acceleration of foreign direct investment in the country and a growth both in real and rupee terms in the first 2 quarters of this fiscal year reflected the favorable long-term growth outlook. A rapidly rising middle class and increased domestic spending as well as consumption will play a significant role, it said. However, different agencies have predicted the time of this achievement differently. According to the International Monetary Fund or IMF, if the nation maintains the current growth trajectory, India will overtake both Japan and Germany by 2027. India's economy would be $5.43 trillion against Germany's $5.33 trillion by then. It will also overtake Japan, who is poised to be at $4.57 trillion. So, how will India's economic growth help its citizens? Sonalde Desai of NCAER believes as the economy grows, it is expected to generate a multitude of new formal employment opportunities.
I definitely see a movement away from agriculture into wage work. Okay? The question is whether that wage work will translate into the salaried, stable job with benefits. Okay? And here I'm a little bit pessimistic. Because one of the things that we have been seeing even in the Western countries, okay, is that there is an increase in non-standard work. People get monthly salaries, okay, but they don't get benefits. They don't get long-term contracts. Now we are seeing this emergence of informality even within that formal sector. Even the government is now hiring contract workers. So what I would say is that we'll certainly see some transformation away from daily wage work. What we will not necessarily see is a growth of a stable employment.
However, some economists believe that the S&P Global's projection is a mere arithmetic of growth and exchange and might not necessarily translate into actual benefits for the masses. They believe that calculation of India's growth rate is relative to the rate of growth of Japan and Germany, which the S&P report itself says has been slowing down in recent years. Even the assumptions of growth rate might see some bump in itself as the years progress, and the estimates may have to be revised. Also, despite currently being the fifth largest economy in the world, India was ranked 111th out of 125 countries in the recent Global Hunger Index list. Experts believe that the country's growth story has been two-faced. A certain section is reaping the benefits of growth while another is struggling to lead a decent life. So how will this growth impact the standard of living?
So I think higher growth certainly leads to higher standard of living. And of course, it will also lead to inequality. I think this is exactly what the advanced countries are facing right now, that inequality would certainly become a problem. But while at the same time, the mean standard of living of all the people certainly is expected to improve because we have a slightly better distribution mechanism.
One of the most critical aspects of this economic transformation is the potential for improved healthcare. Economists say that as the country's economic prowess expands, there's an opportunity for increased investment in healthcare infrastructure, research, and development. However, it is important to note that economic growth alone may not guarantee an equitable distribution of its benefits. Income inequality and regional disparities may still persist and challenge the common people's access to the opportunities that come with a growing economy.
There could be some people who, in the US, you have that whole debate between 99% versus 1%. So I think even in India also, there are some debate between 90% versus 10%. So that kind of inequality would certainly be there on the income side. But at the same time, there could be regional inequality, there could be urban-rural divide, there could be inequality when it comes to educational outcomes, there could be inequality when it comes to health outcomes and nutritional outcomes. So all those outcome-based measures will have to be addressed.
India is expected to rise to the third largest economy by 2030. Holds the promise of significant positive changes for its common citizens. The potential for increased formal employment, improved healthcare, and enhanced living standards is substantial. However, it will require concerted efforts to ensure that these benefits are distributed widely and equitably.
But right now, geopolitical uncertainty is keeping everyone on their toes, whether it is the tech industry or the financial markets. It is also keeping crude oil on a boil for a while now amid a cut in supply from Saudi Arabia and Russia. At the bourses, stock of oil exploration companies such as ONGC and Oil India have done well in this backdrop. So is it time to load up on stocks of oil exploration companies and exit OMCs? Puneet Wadhwa brings us some answers in our next report.
Stocks of oil refining and marketing companies have done well so far in fiscal 2024. The Nifty Oil and Gas Index has gained nearly 6% thus far in FY24 as compared to 11% rise in the Nifty 50 during this period. However, the higher for longer narrative seemed to be playing out not only for interest rate but also for crude oil prices, which analysts feel could impact sentiment in the short to medium term. In FY24, Brent oil prices have shot up nearly 17% to around $97 a barrel. Besides, supply cuts from Saudi Arabia and Russia, which were followed up by the Israel-Hamas war, have been the key reasons for the surge in oil prices in the last few months. This comes at a time when the International Energy Agency expects demand for oil to likely remain strong, at least for now. So what should your strategy be for the stocks of oil refining and marketing companies? Analysts at GM Financial remain cautious on the road ahead for oil marketing companies such as HPCL, BPCL, and IOC if oil prices sustain over $90 a barrel mark for long. They believe their marketing segment earnings could come under risk if Brent prices sustain over $90 a barrel. That apart, another worry for OMCs are the upcoming state and the general elections. Analysts feel the government could keep petrol and diesel prices in check despite fearing crude oil as a populist measure.
Upstream PSU companies like ONGC and Oil India could see some benefit from modest growth in oil and gas sales volume and slightly better net oil realization post special additional excise duty and the rupee depreciation. Petrochem business continues to remain under pressure due to soft demand and volatile prices. Refining margins are likely to improve amid rising benchmark GRMs due to rising diesel cracks, and refining companies could also see some inventory gains. But this could be offset by auto fuel under recoveries amid high crude oil and petroleum product prices and no change in the final auto fuel prices. Oil exploration and refining space is cyclical and investors need to time their entry well. These stocks at some level are also good dividend play stocks, given the pressure on them to declare large dividends. For the time being, oil exploration companies seem to be better bet than the refining companies.
On the bourses, ONGC has been one of the star performers in FY24, rising over 22% thus far in FY24. GM Financial maintains a buy rating on ONGC with a target price of 220 rupees and on Oil India with a target of 345 rupees. Thus, oil exploration companies, analysts believe, are a better bet amid the ongoing upswing in oil prices. On Thursday, the markets will take cues from global developments amid the ongoing September quarter results season back home.
He's making plans for an early retirement. Business Standard.
It is not just the geopolitics, but the domestic politics too is simmering. After Bihar's caste survey, politicians in Maharashtra too have demanded a similar exercise in the state. Clearly, everyone is eyeing OBC votes. But who are OBCs? Rimjim Singh explains.
The other backward class, or OBC, is a term used to denote castes that are educationally or socially backward. They don't include scheduled castes and scheduled tribes. The need for targeted government benefits was felt much before the Mandal Commission proposed reservation for OBCs. During the late 19th century, soon after the Crown took over reins of India from the East India Company post-1857 rebellion, there was a rising concern that a big chunk of the population was being ignored by the education system. A study showed that though Brahmins formed just 3% of the population in the Madras Presidency, they accounted for 60% of the graduates, and only 16% graduates came from other castes, which constituted 80% of the population. It led to a series of educational reforms, especially for the SCs and STs and the Muslims. Special schools and fee concessions were part of it. Over a century later, the condition of backward castes has certainly improved, but they are still way behind the forward castes. Action for OBCs is mandated by Article 15(4) of the Constitution, which states that nothing in this article or in Clause 2 of Article 29 shall prevent the state from making any special provision for the advancement of any socially and educationally backward classes of citizens. Article 15(4) and Article 16(4) form the basis for reservation in education and employment. In December 1980, the Mandal Commission, in its report, pegged the share of OBCs, which includes both Hindus and non-Hindus, at around 52% of the total population. And in 2006, National Sample Survey Organization put OBC's share in population at 41%. The OBCs have been generally identified on the basis of their occupation, which includes cultivation of own land, tenant farming, pottery, agricultural labor, carpentry, blacksmith, stone cutting, among others. The Kalelkar Commission, headed by Kaka Kalelkar, was constituted in 1953 and submitted its report in 1955. The Commission made a list of 2,399 backward castes in India and categorized 837 of them as most backward. However, the report was never implemented. In March 2015, the National Commission for Backward Classes, then headed by Justice V. Iswaraya, said that OBCs should be subcategorized into extremely backward classes, more backward classes, and backward classes. Over the years, state governments have applied their own criteria to distribute quota benefits among various OBC categories. The Mandal Commission, headed by B.P. Mandal, was announced in December 1978 by then Prime Minister Morarji Desai of the Janata Party and was set up in January 1980. The Commission identified 3,743 castes and communities as OBCs and estimated their population at 52%. The Commission recommended 27% reservation in government jobs. OBCs enjoy 27% reservation in government jobs and higher educational institutions. For SC, it is 15% and for STs, it is 7.5%. Economically weaker sections get 10% reservation.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
Experts meanwhile are saying that to counter the impact of Bihar's caste survey, the BJP could implement the Rohini Commission report, which seeks fair distribution of benefits among the OBCs. Well, that's all we have for you today. For more news and analysis, please log on to business-standard.com. Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.